Well, thanks so much, and we really appreciate the opportunity to join everyone today and speak at the forum. I think we're relatively new in the sense that our U.S. platform really is only a year old at this point. But what we wanted to do today was share a bit about our heritage and history. The firm does date back to 1993 with a tremendous amount of experience in the housing sector. And I think we also really appreciate being able to have forums like this in a time in which it is difficult to get together and making some of these connections. And we've been very active with FLIA and look forward to being very active in the future. We thought today it would be interesting to talk about some of the trends that we're seeing in the home building space, specifically from our vantage. We have been very active in across various U.S. markets, speaking with small, medium-sized sponsors and really understanding how the landscape has evolved, since the great financial crisis and to today. And we wanted to share some of those perspectives with the audience. And then as well as how we're thinking about it as far as it fits within our both debt and equity strategies for the housing sector. We're also going to spend a few minutes just talking about us too. I think as a firm we're relatively new, and so we wanted to share our heritage. And then at the end we'll talk about our strategy around how we've thought about approaching the asset class. So Yellowstone Capital Partners is a firm that was started in 2010 in Bogota, Colombia. A bit of a unique history in the sense that we first started in the Latin American markets and migrated into the U.S. Rather than the vice versa. Today we manage just north of 400 million, and we do everything from investing in large-scale residential projects, all the way to some mixed use and a few shopping centers that really add to the community in the neighborhood. The team has a really deep bench of experience, across all the verticals within real estate that really we think makes the business thrive. We have seeded our U.S. operations with investors who have been long-standing investors of the firm, and so some key institutions as well as our own partner capital. And really our strategy in the U.S. is to focus on a number of, let's say, underserved or what we think to be mispriced segments, and do it in such a way where we believe that we can either uncover value as a private equity investor through rolling up that segment of the market, or we just think that the capital markets have mispriced it, and we think we can unlock some spread compression. So when we take that over to the home building sector, we think that there's all the characteristics that we have been able to deliver over the years for our investors in Latin markets here that exist in the U.S. And first and foremost, what we see is that there's been really a convergence of both near-term and long-term factors over the course of 2020 that have just created this very favorable environment for the housing industry. And furthermore, we think, and we've seen that as banks have pulled back their construction lending, primarily because of regulation, not because they're just not the best source of capital for it. We think it's led to permanent structural advantages for private capital. And kind of looking at where there's been economic fallout as a result of COVID. Housing is in a bright spot, and we think that the repair that's been done after the financial crisis has led it to be much more financially stable. And we think the amount of fiscal monetary stimulus coming in the form of from federal to both local level will help continue to stabilize the market as we kind of get through this very difficult and transition period. What we've also seen is, that really, I think to excel in this segment of the market, it requires specialized expertise. You can't just show up with, and assume that, the deals will structure themselves, and a tremendous amount of very proactive operational oversight. For investors looking to get into home building, there's been a number of software platforms as well as lots of third-party service providers that can certainly help, I think, make the platform very efficient. But it really comes to the end of the day that you need to know what you're doing, to have that kind of that that those battle wounds, if you will, to be able to ask the right questions and to see where the pitfalls lie. Talking a few minutes about the firm itself. We manage just north of 400 million. We have developed our home building expertise really through a strategic partnership with one of the largest construction companies in South America called Amarillo. That firm has been around since 1993. It's the number one largest real estate group in Colombia. They have developed over 83,000 units, 2,000 employees, and have sort of defined themselves as one of the predominant leaders of high social impact and environmentally sustainable development. And they develop a lot of attainable housing for kind of low to middle income residents who are looking to break that poverty cycle and kind of seek that upward mobility. They've built large scale communities that have unlocked that part of the segment. So we're really proud to be part of that firm. And as such, we've adopted the principles of responsible investing inside of our investment strategy and consider environmental, social, as well as good governance, throughout all of the investments we make. As you can see, our U.S. operations were based here in San Francisco, as well as we have a satellite office down in L.A. We've been able to deliver to our investors over the years, high teens returns on a gross basis, and we've both, done it on both the equity as well as the debt side. I'm joined today with JP Ackerman. JP really heads up, I'd say, our front line for Yellowstone here in the U.S. He brings a tremendous amount of knowledge, being a home builder himself, working for one of the large national publics, as well as being an entrepreneur. And so he can really wear a number of hats and think about some of these smaller to mid-sized operators who are not only thinking about how to scale their business, but also trying to navigate the challenges of capital markets and the financing side of it. Myself, I have 18 years of real estate capital markets experience, sort of spent the last 5 years as an investment manager, as well as building up capital markets for one of the largest residential bridge lenders in the country. Prior to that, I was at Fortress Investment Group in New York for 10 years. Really saw the boom and bust of the great financial crisis and had a front row seat in terms of buying billions and billions of distressed assets, working those out, buying some defunct servicing and mortgage platforms, and have really been able to take that cumulative knowledge. And when we talk about the opportunities in home building, we see that the likings of many of those fragmented markets that we were part of during the great financial crisis still persist today in one form or another. And we'll kind of go into that in a little bit more detail. And then talking more broadly about the group inside of YCP, the group on average has about 22 years of industry experience, and we have 15 full-time employees. And that experience really spans across 4 key verticals that we think roll up to give us that edge, if you will, to both build a vertically integrated platform, as well as deliver that institutional expectation to our investors. And so worked with a number of very preeminent firms on the investment management side, as well as on the lending. On construction, we've been part of Pulte, as well as having the team at Amarillo at our back, and then as well as be very forward thinking in terms of how we utilize data and technology to give us a lot of lift. And with our partners at Neptune Finance and at previous firms like House Canary and Lending Home, have all given us that knowledge. So going into the home building segment, we first want to just define what we mean by home building. And what we have seen based on our own internal analysis is that the market that we think is addressable is about 50 billion a year. And what it's generally characterized by is that we've seen a significant amount of consolidation among the public home builders, who the top 10 represent about a third of the market. But it quickly drops off from there, and that dynamic exists really as it becomes more and more challenging for the public home builders to find land that to be able to put in their inventory at their scale. It leaves the door open for smaller operators who are doing infill projects, or are able to work know that local entitlement process. But again, this is not quite at the same scale that the public can be. And so, we see this as it will likely continue to persist, and very, very bankable in terms of, for it to be for private lenders. The project types that we're defining as home building, that would range everything from, a build to sale development, a build to rent development, where, it'd be an institutional investor acquiring the community. There's master plan, which can have multiple phases to it, as well as there could be, sort of shorter cycle infill, where there's already infrastructure and horizontal improvements. We generally exclude the sort of renovation segment, and we'll describe why, kind of commonly referred to as fix and flip. And so, but the others we think are really define what we see to be this market. And looking at the project phases, there's a typical arc to a home building project. Can go from, the raw land, which would be pre-entitlement, to, the value improvements that occur from getting it zoned and entitled, for its intended use, doing the infrastructure work, which we call the horizontal phase of it, then the vertical phase, putting the pad and the structure, either leasing up or selling it to an end retail, and then possibly even stabilizing it with putting a tenant in place. Looking at some of like the fundamentals that's driving this segment, we still see, despite I think 10 years of very good growth in the housing sector, a significant amount of underbuilt in the new construction side. And so we are absolutely still in the early days of what we consider to be a very sustained housing growth period. And in part, that's because of how much decline there was as a result of home construction starts following the Great Recession. And, to put some numbers behind it, we were trending at about 12,000 starts per million, and dropped to only 2,000 starts. And as you can see from the graph, that number's only been slowly rebuilding, and even more exacerbated by, the population growth, which means that we're further underbuilt. The long-term average is about 1.4 million. And so you can see that there's about a 2.5 million unit shortfall, which, if you start looking at what, home builders can deliver on a consistent basis, that implies about a 10-year supply gap. Furthermore, from a demand side, this has been very well documented, by Harvard Institute and by other institutional investors, but they're very favorable demographic trends indicating that there's further tailwinds in terms of millennials now moving up into ripe home buying age, with an average of about 1.2 million per year, which is trending about 20% higher than where it's been in the past previous 5 years. And so you have this confluence of undersupply with more home buyers coming to market, leading to to even further supply constraints. What the chart is showing, and it's meant to demonstrate, the light blue line showing the sort of the 20 to 34-year-old cohort, which are typically the renter class, swelling in like in the mid 2000s to now on the decline, and then the dark blue line representing sort of the home buyer segment being at net declines throughout the mid 2000s, and now in previous couple of years, and as well as into the future, that now becoming net areas of growth. With COVID, really, sort of shaking up the way in which, we think about mobility and work from home, we see these as trends that are likely here to stay, and reacting to, and I think embedding some of those trends inside of home builders investment analysis, as well as how they think about building their model homes, is also a dynamic that investors certainly need to be considerate of around looking at home building opportunities. And one trend that we've certainly been well cognizant of is that there's been a flight from urban to suburbs pre-financial crisis, or excuse me, pre-COVID, but that also has been accelerated. But we think that trend will be here to stay, and as well as migratory shifts away from high-cost markets into Sunbelt regions, as well as some very tax-friendly states. And so the map on the right, the deeper shade colored states represents the net immigration inflows, and those will continue to take hold. From a opportunity perspective, really, as if we go back to 2010, 2011, with Basel III and as well as a number of federally mandated regulations, the banks have really pulled back specifically in this segment, and it results in a very favorable environment for private lenders to be able to both not only structure deals which we think are under lender friendly terms, but also in under pricing that we think is very attractive in this market when we're all struggling to find yield inside of our portfolios. Really two types of product. There's sort of the pre-construction, so that'd be for acquisition development, and you find conservative loan to cost ratios in the 60s, loan to values in kind of the 50, and the duration of the asset being sub 2 years, and returns in kind of the low teens. Also important, worth highlighting, is that the structure itself often entails the equity going in first, 100% of it, and then the debt building up over time. And so the peak exposure really comes when the project has de-risked towards the finish line is in sight. Vertical construction, being a little more certain around what the takeout looks like, and oftentimes the projects are shovel ready. Leverage goes up to 75% of cost and kind of 65% of value, and rates a little bit more competitive in the kind of high single digits, low double digits. The last point that I wanted to share before handing it over to JP is just thinking about how relative value plays out in specifically around private credit for home building. And if we think about just how much the pendulum has swung from being a very unloved segment, despite a lot of tailwinds that I shared, it's really been at the heart of the economic rebound. I mean, everyone thinks about their home, and home improvement's been one of the biggest GDP contributors, really in 2020. And we also see a tremendous amount of policy, like support from policymakers, that we think will ultimately really keep the market stable and kind of mute the amount of distress that we think will actually come to bear. And so then we think about how home building compares relative to other niche private credit alternatives. We think it pairs up quite favorably, with yields in the low double digits. Still very little competition, just given the amount of moats that exist around getting set up into the space. Short duration, while also at the same time being able to be part of a developer has multiple phases. So kind of having the check-ins along the way and decide whether or not to continue with the project. Conservative leverage, and really being able to back very well capitalized sponsors and do a full underwrite. And so that you compare that to what looks like in traditional fix and flip. You do get broad diversification. Usually they're lower loan balances, but it's very fast, streamlined like underwriting. Usually property based, and so you don't quite get to have the depth and coverage that you get in the home building space. And I think on the cons, the market is very interest rate sensitive. However, JP will touch upon how there's been other distribution channels for home builders that arose really in the last 10 years that have created a floor on some of that interest rate sensitivity, and how it's been heavily mitigated. And then lastly, I think thinking about it in relation to other asset classes, just given the relatively low amount of competition, we think you can structure terms that are very favorable for lenders. I think I'll hand it over to JP now just to talk about how we think about deploying the strategy and capital into the segment.
Yeah, thanks, Paul. And as a home builder for a decade and living really through the boom and bust of the last cycle, we really see an enormous amount of shift from what were the key risks that underpinned the last cycle versus how well-founded we see the current state. Certainly, we see a lot more discipline. We see an enormous amount of a growing population, migratory buying, key theses of dispersion of like really high-wage tech jobs. But when we look at the kind of comparison, and if you go maybe back one slide, Paul, when we look at the comparison here, the underlying affordability of the marketplace is such that we see it being on par with 2002 versus in the last cycle, we really saw it being the worst we had seen in 20 plus years. When we look at the credit quality of buyers participating in the market, we see a step function shift up. Underpinning that, the down payments are 4x what we saw last time. So we look at like the key things that ultimately built into risk factors for demand. We see that really moderating. When we compare that to the home builder activity, really driving a lot of what land values and execution styles, we see a significantly lower leverage. We're about half of the leverage, and with the kind of leaders like Lennar and D.R. Horton being 20% on average in terms of debt to cap ratio. We just see a lot more thoughtful discipline about how to build these businesses. Most importantly, I think, as we think about small builders all the way up to large scale builders, the execution went from being one approach of build to sell to many different strategies that can be deployed. One of the most exciting ones right now, I think it's generating a lot of enthusiasm, is build to rent. And as a comparison, if you flip to the next slide, we look at a deal about what does this opportunity for an alternative execution bring to bear. The property that was cost to build about $240,000 would typically just go out to market to sell at something about $300,000 in today's world. It's a good 20% margin, but where we see exit cap rates right now in single family build to rent communities around 4.5%, there's an enormous jump up here in terms of the margin that can be gained. And ultimately it creates an alternative style of execution that, frankly, massively de-risks the way that these projects come to bear and unlocks a lot of land opportunity that further expands the total addressable market. So when we think about this, one of the things that really attracts us to the properties as well is that our debt basis in these properties is significantly below that cost to build, giving us an enormous room for protection. So as we start to think about if we flip to the next slide, Paul, as we start to think about what it means to really take and enter this marketplace, for all of you guys that are thinking about this, a lot of the things that we look for are born out of the operational expertise we have. Sitting and understanding land and construction from our vantage point allows us to go in and engage with sponsors that understand how to navigate these risks. A great property with an inexperienced sponsor spells out high risk. A mediocre property with a very experienced sponsor is very doable. As we think about these, we really look sponsor first. And so we look at that track record, which we emphasize is not one-dimensional. Doing more certainly is better in many ways, but we look for, kind of very similar to my background around venture capital, we look for a learning mentality where we've got a track record that's continuously improved. We've built in deep relationships with key subs. We've built in those speed and learning and capitalization factors from earlier projects that proved to be critical to building out a solid operator. That depth of market knowledge where they understand the entitlement and municipal guidelines, how to navigate those requirements, and be able to kind of capitalize on that over time. Strategy, certainly growth-oriented sponsors is a big deal in investing in this, not only for efficiency of capital deployment, but more importantly, you're looking at somebody who's got a lot of skin in the game over the long haul. Reputational risk is something that it's very hard to quantify, but really stabilizes a lot of the way these guys execute, both for municipalities, trades, as well as the capital markets like us. And Paul's mentioned a number of times, we really emphasize capitalization where there's deep skin in the game, and that we have very aligned interests between the sponsor and us as an investor. Paul, you want to flip to the next? So looking at this, a critical element of how to enter this marketplace is about how to structure all weather investments. We are not naive to think that there aren't headwinds at any given time, and especially with the changing market around COVID. When we look at that, my reference back to the comparative economics slide a few slides back, we aim to go in where we have a really strong basis, knowing that even in the event of headwinds, there's an enormous amount of buffer before we have to, we're in a loss position. So we look at this, we look at, key factors by stage. And so, going back to what Paul talked about, we see 4 major stages of these projects. That entitlement timeframe where it's very high risk. Most markets outside of places like California, this isn't necessarily creating tons of value. I mean, this can be it can be an area where you aim to structure takedowns of lots as a builder after entitlements are done. So you have some at-risk dollars going out. But as an investor, this is a key area where it's really hard to ultimately turn this into a liquid asset. So we think about entitlement risk as being a place we're very cautious on. And we really want to make sure we can kind of maximize the place where we get dollars in once they're shovel ready dirt. Shovel ready, I mean that as being, ready for land development, ready for that horizontal improvement. And so at this stage, ultimately, this is where you're really starting to add physical value to it. And there's more controllable risks. I mean, it's moderate for sure, but it's an area where this is where the operator skill set comes in and is absolutely critical. The exit of this phase is when you get building permits. The entrance into this phase is typically something like a grading permit. These key areas are key triggers, milestones to align with on operators, where we really understand what the risk profile of the land is and the ability to navigate from a raw piece of land, say farmland, greenfield, to something that is really buildable, where real value has been added, and it's a very liquid asset to merchant builders throughout the nation. The vertical construction piece is obviously, this is the place where you're getting a lot of value. You do tend to have risk in these earlier phases of being underwater, where there's a lot of capital at risk and not necessarily easily liquidated. Once you get to vertical construction, this is much more navigable. As we look at this as a place where we really want to put emphasis on operational oversight, draw schedules, and for those properties that are going for rent, the stabilization phase, these are built properties. They're highly liquid. It's a place where we like to play whenever we've been a part of the deal structure from the earlier stages. But frankly, it's the greatest place of liquidity, and it comes with much lower risk, therefore much lower rates typically. As we look at this, and as we go to the next slide, Paul, like an illustrative transaction for you guys to think about. This is a deal that we've been working on in the Southwest. It's about 30 townhomes. It's a build-to-rent style of execution where they came in at about $20,000 per lot, just shy of 50 per lot in development, another 130 in construction, for a total of about 220 in total budget per unit, at a value that's over 300, about 330 per unit. So as we look at this sort of a relationship on the right-hand side, what we tried to illustrate is when we think about bringing debt to bear in these projects, to sort of put a finer point on what Paul articulated, this is an area we want to see the equity going in first. Ultimately, this is where coming in with well-capitalized and well-seasoned operators, puts them in a position to take these early steps and make sure to get through those most difficult phases of improvement to be able to yield value before we come in and ultimately can be pretty aggressive on advance rates to help get that construction, the development and construction completed to a point where ultimately it's a very symbiotic relationship that ultimately prevents us from being in a first loss position on things we really don't control. This is the critical element of, I think, understanding and tapping into that expertise around construction and operations that is very important in this type of investing. So if you go to the next slide, Paul, I think that one of the critical elements for us as we think about how to deliver on our, there we go, back one, there we go. As we think about how to deliver on what our core values are, is really about thinking about how to invest in communities. And I mean that in a holistic way. A great property, a great execution can be transformative to a community. In many cases, that might be attainable housing. Others, it could be using sustainable materials, but it becomes a transformative opportunity in the broader community where one project can lead to the next. It's high impact on the residents within the community or within the property, as well as those that surround it. And we look at that both directly through investing in the development of these projects, but also as we think about opportunities like schools and other operators and ways to kind of improve financial literacy that is very cyclical in terms of coming back and sustaining the types of investments that we make. So we like to think at it both in terms of the broader social impact as well as that from the communities themselves. So with that, realizing we're running out of time here, but really appreciate the opportunity. And as you guys have more questions, put our contact information here. We'd love to share more about Yellowstone, our project, our approach, but believe there's an enormous opportunity in investing in the home building market, as we stated in 2021.
All right, guys, thank you very much for your presentation today. It was very interesting, great information. Paul, JP, thank you guys for being part of our Real Estate Direct Lending Private Debt Forum Part 10. We look forward to having you back and sharing more insights and getting deeper into your niche, your vertical, and upcoming events. So thank you to both of you guys.
Thanks, really.